Have you recently learned about velocity banking and are curious to understand when the strategy might make sense to use and if it actually works? At a first glance, velocity banking can seem like a no-brainer, but in reality, there are many different variables that each individual should consider before committing to a strategy like velocity banking. Welcome to Concepts Made Simple, where we aim to simplify everyday financial and self-improvement topics. If you're looking to get control of your finances and make smart financial decisions, be sure to like and subscribe to the channel down below. In today's video, we'll be taking a closer look at some of these variables around velocity banking and the effect that they can have on the potential benefit that one may get from using velocity banking. If you don't already have a clear understanding of what velocity banking is, I suggest watching our step-by-step guide before watching this video. We'll leave a link to that video down below in the description. But from a high level, velocity banking is a strategy that involves using a line of credit, such as a home equity line of credit, to accelerate debt payoff and by virtue of paying debt faster, save on interest in the long run. However, there are many things that will impact the effectiveness of the strategy, including how high or low the interest is on the debt that you are looking to pay off. For example, imagine you have significant high interest debt, like credit cards or personal loans, with interest rates of let's say 20% or more. In this situation, velocity banking can potentially yield high success. By utilizing a low-interest line of credit to pay off these high-interest debts, you could save a substantial amount of money on interest over the long term and accelerate your debt payoff. Let's take a look at an example. Suppose you have $10,000 in credit card debt with 20% interest. By using velocity banking, you can gain leverage to help accelerate your debt payment with a line of credit. In this example, let's imagine that you have a line of credit that has an interest rate of 6%. The lower interest rate will enable you to pay off your debt faster and potentially save thousands of dollars in interest payments. This is because the line of credit will give you access to additional capital, which one, allows you to pay down debt faster, resulting in saved interest since your loan will be open for a shorter period of time, and two, because the additional capital you're using to pay down your debt comes with lower interest, you will also save in the long run. However, for the situation to work, you need to be able to secure a line of credit at a lower interest rate, which can be difficult, especially if you have a poor credit history. This isn't to say the strategy can't work if your interest on your line of credit is higher than the debt you are trying to pay off, but the benefit you will get will be significantly reduced. Now, let's consider the opposite scenario. What if you have lower interest debt, such as a student loan or a car loan, with interest rates of let's say 5% or lower? In this case, velocity banking may not make as much sense. When you have debt with relatively low interest rates, the potential interest savings from velocity banking might not outweigh the cost and efforts involved in setting up and managing the strategy. Let's say you have a student loan of $30,000 with a 4% interest rate. If you choose to use velocity banking to pay off this debt using a line of credit with a 6% interest rate, the interest savings would be minimal compared to the additional costs associated with the line of credit, such as opportunity costs, which we will dive into shortly. In this situation, it may be more beneficial to continue making regular payments on the student loan while exploring other investment or savings opportunities. This leads us to another crucial factor, and that is that most lines of credit come with a variable interest rate rather than a fixed rate. This means that your interest rates on your line of credit can fluctuate over time, potentially impacting your repayment strategy. For example, let's imagine at the start of 2022, you decided that velocity banking may be a good strategy to help you pay off your debt faster and save on interest. The interest rate at the time on your line of credit was 4%. But as economic factors changed throughout 2022 and 2023, interest rates went up across the country, increasing the rate on your line of credit to 7%. As you can see in this example, the impact velocity banking will have will vary greatly depending on the interest rate on your line of credit. Meaning, at a certain point in time, velocity banking can look like a wonderful strategy, but factors out of your control can quickly change, potentially making the strategy less appealing. However, even if you map out your velocity banking strategy and feel confident that you will save on interest while also taking into consideration fluctuations that can occur around interest rates as we just discussed, you still may be overlooking a significant factor, which is opportunity cost. This is because when using velocity banking, you're committing an additional portion of your capital towards paying down your debt faster. Although this may help you save on interest in the long run, you may be missing out on other opportunities where your return on investment will be greater than the interest you will save from velocity banking. For example, suppose rather than using velocity banking, you have an option to invest your additional capital in other opportunities that have historically provided an average annual return of 8%. In this case, it might make more sense to allocate your funds towards those investment options instead of accelerating your debt repayment. By doing so, you could potentially grow your wealth at a faster rate. It's important to analyze the potential returns from investments, the risk involved, and your personal financial goals. By considering opportunity costs, you can make an informed decision on whether to prioritize velocity banking or explore alternative investment opportunities. All in all, there are many different factors to consider when looking into velocity banking. It's crucial to always consult with a qualified financial advisor or professional who can assess your individual situation and provide personal advice tailored to your needs if you're evaluating a strategy such as velocity banking. Thank you for watching, and if you found the video helpful, be sure to like and subscribe down below to stay up to date on a wide variety of financial and self-improvement topics.